What's going on, everybody? Jeff here. Welcome back to the channel. Another bloody red day in the market seems to be the theme lately. The SPY pops at the open, just sells off all day long, then gets a rally into the close. I'm going to go over with what happened today, why the market continued to sell off, and we'll also take a look at where the next support levels lie for the SPY. One of the stocks that led into the rally at the end of the day was AMC, getting all the way down to that $25 level before roaring back almost 15% to $29. Now, don't forget, AMC has not spent a lot of time in between that $20 and $30 price range. In late May, once we got through 14, it was a quick stop at 19 and broke right through the 20s, getting back up to that $70 level, finding a lot of support and resistance in between the 30s and 40s, as well as in the 60s back in June. But the 20s are an unfamiliar territory. We're going to go over a little bit where they stand. And last thing I want to talk about is the tech sector heavily weighing down the entire market. I was taking a look at a chart that I'm going to show you in this video, talking about broker dealers and the excessive amount of money on margin that is invested inside the stock market, with the tech sector being valued at future revenues, the insane amount of money on margin, and interest rates ready to rise around the corner. It is a recipe that is set up for disaster. We're going to go over everything in this video. Let's get right into it. As you can see right here, this very, very little bit of green. You could see a little bit of spike right at the open, little pop, and then just selling off all day long and then getting its little rally into the close. The catalyst behind this was another jobs miss. Now, here is the difference between this month and the last few months. So jobs have missed for the last few months, and they've missed absolutely horribly. As you can see, increased by 210, and the expectations were 573, another massive miss. But investors are looking at this a little bit closer now, because Jerome Powell said he wanted to wait before asset tapering was going to begin and interest rates were going to rise until the labor market was going to return to be a little bit stronger. And here you have unemployment rates dropping, but people are not going back to work. And as you can see, the estimate was for 573 and a 4.5. And you're kind of seeing this uneven mixture right here of unemployment being very low, but people aren't going back to work. And this is really starting to worry investors. They realized back in August, September, and even I guess you could say October, that maybe people were not going back to work because they still had some stimulus money. Unemployment was freshly running out. Maybe they couldn't find jobs, even though everywhere is hiring. But now it is getting to the point where the Fed is ready to take action, and still the labor market is struggling. Investors are worried about that. Now let's take a look at AMC, sitting at 29.01 as an intraday low. I believe it was 25.31. It got a very strong bounce coming into the close, as did the entire market. You could take a look at the SPY, getting a nice bounce after just popping at the open, selling off all day long. The same thing with the QQQs, where you have all of your tech stocks heavily weighted, and IWM as well, which is all of your small caps. One thing I will point out when it comes to IWM, who has taken a very heavy hit from reaching all-time highs in early November. It has a lot of support around this 210 level, which we are closely approaching. That is a good sign, as we did just break below the 200 moving average. Something similar with AMC as well. We broke below that 200 moving average, and we don't have a lot of support in the 20s. As you look left, you can see these candles just blasting right through there as we got back in May. If you do zoom out to the weekly chart and get all the way back over, as you can see, we don't have a lot of support there as well. One thing I will point out that was a good sign today was look at the volume coming back into the stock. We haven't seen candles like this, 200,000, 500,000. And even if you look at the daily, it was 65 million shares traded. There was a lot of shorting going on, whether this was retail shorts, hedge funds adding to their position, trying to bring the price back down. Some of the pop at the open was longs being added, and also retail shorts that were using this as nothing but a day trade, getting out of their position in the end, the play still stands from where we were back in January, in March, in May, in June, July, August, and this month. The shorts still hold their positions deeply in the red. All right. Now, last thing I want to talk about is this right here, and it kind of does relate to AMC. You see the QQQ 380 has been a very significant level. It is now approaching, it slightly broke through the 50-day moving average and approaching that 100-day moving average. Well, if you take a look at this chart right here, you can see, look at this parabolic movement of the amount of money that security brokers and dealers and their margin accounts at broker dealers, which is basically the amount accessible on margin. Well, some of this needs to be curtailed because interest rates are going to rise soon. Liquidity is going to change. The amount of money that banks are able to lend out is going to be shrank a little bit because of the debts that they have to pay on that. It's only natural. And when you know about some of these tech stocks, that's why you can see companies like Tesla that were valued, at 600 billion, never turning a profit at one point. And I know Tesla got into that 1 trillion, but they are a little bit profitable, even though it is some of the rebates. But even like a year and a half ago, or I'm sorry, about a year ago, when it was valued at say 500, 600 billion, they never turned a profits. It's because of their future revenue. That's how a lot of these high growth tech stocks tend to run. And when a lot of companies and investors and funds are investing into these companies on borrowed money, it becomes a little bit more risky. And that's when they need to curtail some of their positions. So I'm expecting to see a little bit of bounce happening at the 380 level. If we see a break through this, get back down to that 374 and beneath that at 355, which, like I said, we haven't seen a pullback in the SPY. We did see one in the QQQ or the NASDAQ back in early February. There was some of our tech stocks, the EV sector was just insanely overinflated. That's natural to happen. That is eventually needed to happen. And it's the same thing with the SPY. It is respecting that trend line that I have continued to come down. And last time we saw the breakthrough of the 50-day moving average, we even broke under the 100-day moving average before seeing a little bit of divergence and then moving much back quicker to the upside. So we do have a lot of cash sitting on the side. As everybody that, I'm investing, I have a lot of cash on the side ready to be able to find that curl to happen. Some of the intraday plays are nice. We haven't had any runners really this week. I think we had a handful, but it was nothing like the week prior that we had. And like I said, investors are just a little bit skittish. If we do see that correction territory happen, it's all the way back down at the 420 level. Now, a correction territory is 10% drop from all-time highs. So at 10% is 47, round that to about 50. We're looking at about 426, I would say. 426, which puts us exactly at that 200-day moving average. You would expect a lot of the QQQs to get pulled even harder, as anything that becomes too risky is the first one to go. Okay, your stocks, your slow movers, your Walmarts, your cyclical stocks. All right, anything that is slow moving, not a lot of risk, is going to recover nicely and easily. Those are the ones that investors tend to hang on to. Anything that just becomes overvalued and insanely risky, those are the positions that get cut first. And if you're looking at a position that is probably insanely risky, it is maintaining a short position of sub $14 at AMC when retail has held this very, very strong, and you are a 50% move away from getting even and or 100% loss out of your short position sitting at the $14 level. So this next week will begin to be interesting. Now, I did make a joke earlier saying that the Santa rally was pushed off because Christmas is pushed off until about February due to inflation. But I still expect the next couple weeks, the last couple weeks of this December, to get a little bit of rally. If you remember, October and November, every month started very similar. October was very slow. Last 2 weeks were strong. Same thing in November. And already a couple days into December, 3 days into December, we're already starting to see that. So just be patient. Markets run in cycles. Don't go chasing any trade that you don't have to get into. I am posting my pre-market picks every single day. Some of them have been a little bit slower, and that's just because the market that we're in. So rest up this weekend. I'll see you in the next one.